Hello and welcome to the cash flow from financing video. In today's video, we'll be learning about what are cash flows from financing. We'll also be learning about a variable known as invested capital. So we'll run through a quick calculation, show you the equation for invested capital and why it's important. And then we'll also do a quick calculation of total financing cash flows. And so we'll do a quick video lesson showing the equation as well as going through an example for you. So plainly put, cash flows from financing are the cash flow activities that show the net funding acquired by your business through investors or creditors. So I'll run through some examples of what those cash flows might look like. So the common types of financing cash flows, first we have issuing or repurchasing of stock. So when your company is first made, you might issue some stock, you might repurchase some stock later on, and then throughout some of the funding process, you might also choose to issue or repurchase some stocks. So those cash flows will show up in this portion. We'll also have any bank loans that you're taking out. So if you're issuing bank loans, you're taking on some debt capital, that'll show up in your cash flows from financing, as well as when you make payments on those loans, those will also show up on your cash flows from financing, as well as any dividend payments. So those will show up in this portion of the cash flow statement. So now we'll take a look at invested capital, what invested capital is and how to calculate it.
So invested capital is the amount of capital raised by the company through shareholders and debt. And what that really means is that our financing, again, can come from either equity investments through shareholders purchasing shares of our company, or that can come through debt financing, where our company might be taking out a long-term loan from a bank. So those are our two financing styles that we can use. And then if we look at the calculation or the equation for invested capital, we could think of invested capital as just the sum of our total equity from shareholders plus the total long-term debt from our creditors or the bank that we're taking that debt from. That only shows us the financing approach. What I have here is actually called the operations approach for invested capital, which might be a little more meaningful when we're looking at a business just in the regard that it shows what we're doing with that financing. So we do assume here that we have the equity and the debt that is equaling up to our assets, which we know from just our basic accounting equation. And so this approach shows us where fixed assets as well as the difference in net working capital, our current assets minus our current liabilities, so what the makeup of our assets are. So let's take a quick look at an example. We have here, we can just assume a random company or theoretical company has fixed assets of $150,000, as well as current assets of $25,000 and current liabilities of $10,000. So if we get an answer for that, we would have our fixed assets of $150,000 plus the difference or our net working capital of our current assets and our current liabilities, which comes out to $15,000. So if we got to a final answer, it'd be $165,000 in invested capital.
So now that we've learned about what cash flows from financing are and the variable of invested capital, we're ready to calculate total financing cash flows. So I'll give you a quick explanation of how we do that, and then we'll run through a quick example for you. So calculating cash flows from financing is fairly simple. We just take all of the inflows of cash from financing and then subtract off all of those outward financing cash flows. So if we have any positives, considering potentially any issuance of stock or any issuance of a bank loan, and we're just subtracting off any of those negatives that would be maybe paying off a loan or any dividends. So here we'll take a look at an example. On the right side, we see a very typical cash flow statement. This is specifically for financing activities. So this is our cash flows from financing activities. And we see that we have issuing stock, we have a bank loan, and we have loan payments, as well as dividend payments. And it's important to note when we're looking at this, exactly which activities are inflows of cash versus outflows of cash. So we see the issue of stock of $9,000. So that would be when we're issuing stock to equity investors. So an investor wants a stake in our company. So we can do that through equity, and that would be our financing cash flow of issuing stock. We can also take out a loan from a bank, which would be on our liability side of our balance sheet. We see here that there's $5,000 of activity in the form of taking out a loan from a bank. But we also see below that loan payments. So we're paying down one of the loans that our company previously has. at $1,000, so that's an outflow, as we see right here is a negative payment, as well as we see dividend payments. And so we have $500 here. That's when we're looking at our net income, we can either take retained earnings or we can pay out some of that money to our investors in the form of dividends. So dividends do show up here in the cash flow statement for financing activities. And when we total that up, we come to a total of $12,500.
My name is Rick Haskell, and I'd like to thank you for watching this video as part of the Bill and Vieve Gore School of Business's Business Certificate Series. I'm a finance professor in the business school, where I'm also the director for the college's Center for Financial Wellness. The Business Certificate Series is offered through the center as part of our outreach through the Gore School of Business. You can follow us on social media through Westminster's Instagram, YouTube, LinkedIn, or Facebook pages. You can use the QR codes provided or simply go to these websites. Thank you.